Hello and welcome to everyone for this month's Ambassador webinar, where we're going to dig deep into the topic of identity. And we're going to do so with one of our favorite people out in the fintech space, definitely one of the funniest. You are going to have a ball listening to this conversation live or watching the recording. Mr. Eli Walks joining Steve and I from Footprint. So, Eli, at this point, fine sir, I know you are stationed in a very top secret spot right now. Was it Starbucks? Is that
Uh,
the
it's
top
top
secret
secret.
location?
Top secret. As a company in the identity and security, I can't give out the location like that, but I can
Mm, mm.
I'm in a coffee shop, and if anybody doesn't find me entertaining, you'll see people picking orders, and you can kind of do some market research, maybe for call share poly
E-
market, most
e-
frequently ordered drinks.
Now,
Exactly.
I will point out you might not want to admit that he's not entertained because his mom typically joins
Yeah,
his LinkedIn
my mom.
friend
You know
too.
what?
Yeah,
And
she'll
let's
be.
give a shout out to our
She'll get
favorite.
real time feedback.
Yeah, oh, sure. I want to give a shout out to Miss Lori Walks. Lori, and it is Lori, if I'm not mistaken, right? Eli,
It
I'm right.
it is.
Can I just say our favorite fintech mother out in the space, hands down, Lori Walks. If you're out there and you're joining, thank you so much for joining us. I seem to be having a little bit of a lag from my side. I'm sure that's my challenge, but here, you know what? The real entertainment is with my gentlemen that are joining me here today, and we're going to get into introductions in just a moment. I do want to go ahead and set the stage though. Here at Ambassador, we have been digging deep into what we call the different layers and players involved in a BaaS technology stack. So, if you are a community bank out there considering entering in the BaaS market, wondering if your current tech stack is sufficient to enter the market, chances are very good that it is, or at least it is in certain layers. Our job here is to ensure that you have all the facts, that you know everything about banking as a service, as well as the different layers of technology providers and enablers involved to help your journey as you onboard more and more fintech programs. Because to be honest, folks, it is going to be very different the way you approach just the mindset of taking on fintech components, fintech programs. Now, the banking aspect, the way in which you roll out your services, your compliance, the identity verifications, those things still remain firmly in your court and still things that you're used to doing. So it's not a completely different world at all in BaaS, but there are elements that we want to make sure that you're completely educated around, including this particular topic of identity. I do want to dig in with our guest, Eli, here. Why KYC, KYB, IDA, IDV, throw in all the letters that we use in this alphabet soup that comes to play with identity, why it's different or should be thought about differently in the BaaS space. Because our goal by the end of this discussion is not only to have you entertained by Eli and Steve, but also to take away some information that may come into play with your existing bank sponsor program, or just give you some insights into how we'd like you to think about the way in which you may be entering in this new space. All right, so gentlemen, just a quick recap here at Ambassador. That is our goal. Our goal is to provide this as an educational forum for community bankers out there that have heard about BaaS, maybe have heard the negative things about banking as a service, all the hot news topics and stories that have cast a shadow over the space. We want to address those, of course, but we also want to make sure that we provide you with a lay of the land and share with you the real facts about the banking as a service space, including the people that make this space brighter when you use their technology to its fullest. And that brings us to our esteemed panelists today. Joining myself and my lagging computer screen, hopefully it's catching up with me a little bit. I do have a gentleman that I know, I've known for years at this point, mainly because I am married to him, Mr. Stephen Bishop, and our special guest today, Eli. Eli Walks, joining us as co-founder and CEO of Footprint. Steve, if you don't mind, why don't we go ahead and let our guest, Eli, introduce a little bit about himself. Eli, tell us the lay of the land in Eli's world. We're here for it. We want all of it, and how you came to found this company called Footprint. Let's go. You've got 2 sentences.
2 minutes, 2 sentences.
Two
Say,
sentences.
say, well, first off, thanks so much for having me. I'm a huge fan of him. I think that this is such an important role of bridging the world of partner banks, of BaaS banking and fintechs, and that this is, on the one hand, the most exciting part of the economy in my mind, and like what companies can do, and also it's where the most can go wrong if done wrong. And second,
So
I
true.
really appreciate getting your husband with the little Uno reverse card there. It sounded like you were going to let him introduce himself,
I
but
know.
instead you're letting him know he was second up in the queue, which I appreciate watching
I
his.
mean, his face, did it sink? Was he like,
He was excited. Yeah, he was so
yeah,
excited, and then I felt like I took something from him, and now I'm way over my 2 cents allotment, and I haven't
no,
said a
that's
thing.
fine.
So,
You go. And I
about
was just joking on the 2 sentences. You can talk about the ambassador
you're
aspects as
too
much as you
kind.
want.
Yeah, so Footprint, we think of ourselves as we provide really 2 core things to fintechs and banks, and one of that is identity. So end-to-end onboarding for KYC, KYB, AML for banks, and the other are really AI agents for financial crimes investigations, for manual review, and really bring these 2 worlds together. I think that it's very exciting to us, in that KYC it stems from almost a Patriot Act. It comes from this idea that we need to make sure that we understand who we're letting using our banking rails in this country,
Yeah.
because the government has a very vested interest in making sure that's not used by people who they don't want. We saw a pretty hot topic, at least in fintech Twitter this week, of kind of a bank that came under some controversy, a neobank, for potentially letting people on OFAC lists use their rails. That story is still coming out. So we see how these are very real. They're not just acronyms that sound scary. They have very real consequences if they're not properly followed. And then on the other end, we see this real interesting time where AI could let us kind of change this toggle of, it used to be banks have really optimized SOPs for how much time do they want to let investigators look into crimes versus how many cases do they want to investigate. And AI has really changed that paradigm of, well, what if you could look at twice as many cases and twice as many controls, because it's much quicker to review them. So we feel very lucky to get to work on that forefront. And I think as a result, we get to work with some of the most forward-thinking banks and fintechs today.
Undoubtedly. I love it. Well, thank you for that introduction, Eli. You're going to hear much more about Footprint as we get going today. And Steve, I know our kids have been playing a lot of Uno since the holidays. I will not use my skip card or my draw for wild. I will allow you to introduce yourself. I will encourage you to. Please share with the people a little
Well,
bit
you
about
know,
you.
and Eli, what she typically does, because as a moderator, she can mute speakers. So
Yeah.
she'll turn it over to me and then not take me off mute. Be like, oh, he's having trouble. Let's just move on. So, so I'm Steve Bishop. No, I'm really excited for this conversation. I think for those out there, if you're not following Eli on LinkedIn, he has a great entertaining posts. And I try to comment as much as I can with my snarkiness, and which leads to even more fun. But it should be a great conversation. You know, KYC, KYB, all the alphabet soups. It is a regulatory requirement for banking, but it's not always like it. Sometimes it's more of a checkbox. Like, you're doing it because you're told to, not because of the benefits of stopping fraud. Like, you do need to know who's out there. So excited to dig in and learn from Eli and learn more about Footprint and this, like, let's talk about identity.
Well, let's go. I'll try not to mute you when you're saying something nice. I only do that, you guys, whenever he does something around the house that annoys me. That's typically the only time that I
As you should.
as I should. It is my right. It is my right. Thank you, Eli. I knew we liked Eli. So here is what we are going to explore together today, folks. Just some of the high points, and we have questions intermixed for these panelists throughout our discussion. We'll encourage you as well, if you have any questions, to submit those out here in the comments for those of you joining us live in the studio. But here's what you can expect. Honestly, why KYC and KYB is different, or should at least be thought about differently in the embedded banking space. Steve, you mentioned a topic, you use this phrasing of checking the box. And I've heard or read from Eli before this same kind of concept. I want to explore a little bit about why this checking the box philosophy or mentality might exist and what's wrong with that mentality. I do also want to talk about something I view as very unique to Footprint, and it's this aspect of unifying identity and vaulting PII information. So we'll get into that as well as some of the KYB challenges that we experience, the industry as a whole, but can be magnified in an embedded banking program. And lastly, we're going to open it up for more of a panel discussion, but do not fear, you will hear from these gentlemen as we get going through these slides that we have here, different this component, this slide deck. All right, gentlemen, first section, and for those of you attending, why in the world are we doing a session on KYB, KYC, and elements around identity? What is so different in banking as a service? Well, in the banking as a service model, at least is the way from Steve and I, our lens, traditional KYB, KYC programs were built more specifically for one bank, one particular brand supporting that bank, and a relatively stable customer base. You know, for the most part, branch employees know who the customers are, or you have more control over those customers opening accounts in an online fashion. And in the banking as a service world, this is drastically changed. You're onboarding through partners at that point. Your risk profile becomes a mix of multiple programs, funnels coming in, but regulators still ultimately view the bank as owning that customer. And so I think, Steve, you correct me if I'm misspeaking for you, but honestly, whenever you plug in that fintech activity into this onboarding stack that you as a banker own presently, and now you're bringing in fintech partners, kind of changes the game. There's just more of everything. There's more volume and velocity. Things are moving quicker. Definitely, I would expect more edge cases and fraud that can be creative. Tell me where I'm wrong there, or are we tracking? Or even more importantly, tell me that I'm right. That's what you should do.
I mean, always you're always right. That's my number one rule. But you know, I think it's interesting to me. So Eli mentioned the Patriot Act, and so if you think about Patriot Act, like it was right after 9/11. Like digital banking was a new thing. Like so there wasn't like online account opening. Like we could barely like only a few banks had the ability to check your account balance. And so the regulations, the boxes that need to be checked were primarily based on a brick and mortar experience, not a digital experience. And we've obviously evolved over the next couple of decades, but now we have AI, we've got this like banking as a service, sponsor banks, we got fintechs, we got all these other areas that are much different than like, but the fundamental of who is your customer hasn't changed. And so like, that's where it's so important to not just accept that legacy provider that has always done it the same way, but look at like, how are you using it effectively to protect yourself, to make sure that you're not only in compliance, but protecting yourself from fraud.
Well said. Well said. I do want to bring Eli into this conversation as well, because Eli would love to give you an opportunity to showcase either that expertise to decline or argue with Steve or I, or agree with us. But more importantly, I want to start off with a question for you, kind sir, if you don't mind. Here is my question.
So
what changes when a bank moves from doing KYC, KYB for its own institution to now growing 5 to 10 fintech programs in the mix?
I think more changes than you would think. I'll give a very real example that we saw this week at Footprint, actually. We work with
Okay.
a partner bank, which we're a big fan of. And by work with them, I mean we have several fintechs that we mutually support. And what's interesting is another one of them went live this week, and they were messaging us saying, "Do you know what it means to hit this endpoint with KYC results for them? Could you ask your other customers who are working with them?" And we went and we asked two different customers who are on this bank, so three total, and all of them had their own answer of what they thought it meant to answer that endpoint. What the endpoint was essentially trying to do was it was essentially trying to get a validation that the SIP that the bank wanted run was properly run and the checks were properly validated. I think this is
Okay.
really interesting question of,
It
well,
seems
what changed
reasonable.
that you may interpret if you're a bank and you're doing KYC, you probably have an interpretation of what that means. But if you have a SIP, a customer identification protocol, and then you give it to 10 fintechs, they're all going to interpret that differently. So I think this is why, I'm guessing that kind of, you may think a lot about why do fintechs need help when they work with partner banks? And maybe that's easier to answer. But I think it's an equally valid point of, why should partner banks, who obviously bring so much, but what do they kind of still need to learn and kind of work with folks like you on? And I think it's exactly kind of these types of areas. This is also an area where we see really exciting innovation. We actually built a tool for then our index here where we can use our AI agents to essentially validate that SIP was run and create a dashboard for the bank. It still doesn't solve that underlying issue of when you go from onboarding your customers, onboarding programs, they're all going to interpret ambiguity in different ways. So something that may feel unambiguous when you write it down, it may not feel that way for others. And I think that's the biggest change.
I think that is so interesting. Steve, have you seen that in practice where you may have the protocol that Eli mentioned, the CIP protocol that is provided to a fintech, and it might be interpreted differently than the way your teams had used or thought about that internally at the bank?
It's like that game where you whisper around the circle and the sentence at the end is completely different, right?
Telephone.
Yeah.
Eli, do you know what that game is? The telephone game.
I played every.
He's young enough. He probably just played it a few weeks ago. But
we did at my bar mitzvah last week.
So absolutely, there's that, like, how they interpret it, that's going to change. But for me, I think the really interesting thing is if you ask, like, so you're trying to know your customer. Well, whose customer is that? Is that the banks? Mm-hmm. Is that the fintechs? Like, they both will say yes, and mm-hmm. they're both accurate up to a degree. But if you ask an examiner, it's the bank's customer. And so that's why 100%. It's so important for banks to choose the right partners, fintechs, but to have clear communication. I mean, that's the key to anything is communication. And so that was a great point that I brought up. It's very interesting.
And to piggyback off that, we see all the time where fintechs have a bank and maybe they're also working with a payment processor. And they'll say, well, I'm doing KYC for the payment processor so I can pass that to the bank. But that's probably not true because the bank probably requirements than the payment processor. And fintechs, they don't want to hear that. They say, what do you mean? I did KYC. It doesn't mean the same thing to everybody. So I think that's the other thing. If you're a bank and you're 5 fintechs, all of them are also going to have different other partners, and they're going to have different interpretations as a result of what they should be doing with their compliance protocols.
Man, that is such an important point to just highlight here from Eli, and that is the fact that your fintech partners, for those of you thinking about getting into the BaaS space, just to reiterate, likely do have other vendors and other relationships to which they are, to a certain degree, performing these types of KYC checks, IDA, IDV checks, other elements depending upon the type of the customer. However, it doesn't mean that the stipulations provided or required by that vendor, that secondary partner, are the same as your institution. You know that inherently. It's tough from, I think, what Eli is sharing for the fintech perhaps to hear that and to understand that there's above and beyond additional components required by your bank. So I do think it pulls back to concepts that each of you have highlighted, and that is communication across the board, and setting the appropriate expectation. That's what I picked up from this conversation. Well, gentlemen, while I have you on this topic, let me ask you this. What are some of the challenges that a traditional bank entering into the bank sponsorship scenario, this environment, like what are they seeing? What would be their challenges in just reusing or launching with their current KYC, KYB provider? Is it the same level of
Happy to. So
yeah.
I'm curious what Steve thinks. I think for me, the biggest thing I would say is, when we go back to what does it mean? Maybe let's take your onboarding a business, and part of your protocol, you want to verify that the business has a physical presence. If you're a community bank, maybe the way you historically did that is you went to their physical presence and you went and you met with them. Maybe if you're doing, a digital program yourself, maybe that means to you accepting a proof of like a proof of incorporation document, an EIN document from the IRS. Once you start kind of doing BaaS, though, maybe you're working with companies that they want to onboard businesses all over the world. So all of a sudden, you're not getting a proof of incorporation document from a business overseas because they definitely do not have an EIN number from the IRS. So I think this is where things start to break, which is your partners likely have different goals of the companies and businesses they want to work with. And also they may want to take on more risk, and more risk does not necessarily mean bad as long as you have the proper controls in place. But you need to make sure you have the proper controls in place. There's always a fraud and friction. If you're taking on a partner that maybe is very excited about taking on more people that maybe have a thinner credit profile, you may want to add checks where you're maybe pinging ECBSV, or maybe you're pinging DMVs to do checks. So it's really about this thing where it's not that your legacy system is bad. It's just that it's not maybe meant to handle the desires of the programs that you're working.
Yeah. Steve, let me turn this question over to you. Eli is talking about the possibility of banks that can expand beyond perhaps more traditional risk profiles when they have solid solutions in place, is what I'm hearing, Eli. Don't let me put words in your mouth. But banks and programs which may have traditionally said no international onboarding or activity with a well-developed program can actually approach that. Is that something that, again, Eli, assuming that I understood and interpreted that correctly, what are your thoughts on that, Steve?
Yeah, I think it's especially for KYB, and like that is a tough one because it's so unique. Like there's a lot of, depending on the corporate structure and the articles organization and the state and the physical press, like there's all these components that have to be captured. A bank I used to work at, their process for their legacy institution got behind to the tune of 6 months. So if you are an officer at the bank, imagine you open an account and then 6 months later you get called like, oh, we're missing this document. Like that was brick and mortar. If you take that and then try to scale that to a nationwide presence, I mean, you're going to fall flat on your face. Like you have to have an efficient process. You have to have the right tools to make sure that you're capturing everything you need so that you truly do know who your customer is, know who your business is. Before you get it, have the right tools and let's make sure that we get it, because when we start sponsor banking, if we have, let's say, a startup, if we have 5 startups, that's great. They're probably going to be slower, like a small pace, but then you want them to be successful. They want to be successful. So what happens when they start to add those customers? It grows and grows. If you don't get it right at the beginning, those problems are going to get bigger and bigger as you scale up.
So it does sound like KYC, KYB, this whole identity topic is one that could and should be explored for a bank that's entering into the BaaS space. Whereas there are other tech stack solutions that translate more easily from the traditional FI side to the BaaS side. But this is one, what I'm picking up from you, Steve, having lived this, Eli, from you probably having cleaned this up for some banks, might be one to explore as you're entering into the space. And it can translate, Eli. Don't let me get this incorrectly, but a solution like Footprint or the identity play can translate from the BaaS side to the traditional FI side, could replace both mechanisms if needed.
100%. And not to, Stacey, you cut me off if I'm jumping ahead. I know kind of idea around like a checkbox. And to me, I think that's a really good example of like, I think that the delta of tools and more so the upside of what new technologies presented really does mean that if you're just checking, I don't think you're doing enough. We're working with, we recently signed a company, like a $10 billion company, and their head of identity said, I wouldn't get fired for, I'll say, using IBM, but he said a specific tool. He said, but I wouldn't be doing my job right if I didn't choose your tool. And I think the big is that we've seen AI recently is a really good example. It completely changed the process of onboarding. What I mean by that is historically onboarding KYC, KYB meant you would collect information and do checks, and then for about 10 to 15% of people and 30 to 50% of businesses, you would then have to manually review them, meaning that somebody or a business onboards, they spend information, and then for about half of businesses, people, they end up in this queue. Maybe that's outsourced to BPO. Maybe you, especially for smaller banks, you maybe have one person internal who for a couple hours a day is supposed to review those applications. That means that you're maybe waiting 3 days to turn around that application. And time is money. In that time, you may lose the person from coming back. In that time, that business may get their application accepted elsewhere. We now see with agents the ability to do escalations in real time. In real time, you can't verify an EIN with a government database, collect an EIN document and run tamper detection on it in real time. So to me, I think that is the upside. And if you're building that partners, you should definitely use that internally.
Yeah, got it. I love it. And you are just slightly hopping ahead. Why don't we get back to that discussion then, gentlemen? Let's move on over to the next section. And that's like, what's wrong with checking these boxes? I mean, Eli, these boxes have existed for years, decades at this point. So I guess I've heard you discuss this very interesting angle of KYC. Does it actually protect the customer, or is it just checking a box even at the bank side? And I'd like to explore this a little bit, gentlemen. Why don't we hop there if you don't mind? Let's go back to our questions and dig into this particular topic. So what do you think? Does KYC and KYB, all of these elements exist to truly protect those customers, or is it to check a box, and sometimes a very friction-oriented box? Eli, I'll direct that to you.
I hope I appreciate you saving me from getting you in trouble with you there, Stacey, for jumping ahead. That was you're a very smooth moderator with the slide.
You're lucky you didn't go on mute, Eli. I'm going to be honest.
I'm shocked. Yeah,
I know I would have.
That's your one warning.
That's strike one. That's the one warning. I think the reason why I would say that I think in a way KYC, if you just look at KYC as a checkbox, is we work with so many companies that have no KYC requirements but do identity check, because if not, they could lose a lot of money, or their consumers could get their identity stolen. So I think that's a great example. Like, this isn't just for pageantry. If it were, there wouldn't be all these industries that are doing these checks now, because they realize if they don't do it, they and their end customers could get hurt. I think when we think about what does it mean for a bank or for a fintech, there are probably two goals. One is checking a box. Like, one is effectively,
you have to.
When your auditors come in, when your examiners come in, you are showing that, and that, because things could happen. So if something happened, at least you put in the controls you said you'd put in place, and that happened, you may not, that could protect you from getting a consent order, or that could protect you from. So that's important. But there's a difference from keeping the business running and having the business thriving. And I think that's where you really see this difference of, do you want to make sure that you're doing what you told examiners you would do to prevent fraud, prevent identity theft, or do you also want to do the things that you're very confident will go the extra mile to do so? So I think to answer your question, KYC, know your customer from Section 243 of the Patriot Act, that is meant to check a box. I think, though, that broader fraud and identity protocols should be are meant to protect customers because they're kind of one and the same. To me, just when you think about it from a math exercise, fraud that's happening to your bank in the name of someone else, like third-party identity theft, is hurting you and it's hurting end users. And on the flip side, controls that you're putting into place to prevent that are helping society at large.
I agree with that. Somewhere along the way, though, it has felt a bit more convoluted, and I'm not sure where this happened exactly. Ultimately, when the Patriot Act came out, here's a quick question for you. Do you know what the Patriot Act stands for, the USA Patriot Act? Do you know that's an acronym?
This is a really bad look for me as a history major.
No. Well, it's a bad look for me because I can only remember part of it. I remember it's uniting and strengthening America by providing adequate tools and resources. See, now this is where you shouldn't ask a question you don't know the answer to, Eli. So listen, I'll mute us
I
both.
didn't know those letters were in Patriot.
Yeah.
That was
Oh, okay. This is our homework assignment, Eli. Before I see you at the next event, you and I are going to learn this and we're going to recite it to each other.
All right.
Okay?
It stands for providing appropriate tools required to intercept and obstruct Terrorism Act of 2001.
Thank you, Stephen Bishop. Thank
I
you.
did not Google
Thank you for your.
that was impressive recall. Says it turn that into a campfire song, and I'll learn the piano, the guitar, and turn it into a next time we all get together. Steve maybe can, given how well he was able to say that.
Oh yeah. Oh, he's the guy. He's the guy. But I'll tell you, somewhere along the way, I mean, this was put into place ultimately to protect the customers. Banks have a role in doing that. Banks are often a common point of interception for these fraudulent types of activities. But somewhere along the way, it did feel as if this was just another burden for a bank to take on. So, Steve, I can imagine from a banker's point of view, these were not in place. These checks, when I was in banking back in the day, when you had to walk to the bank uphill both ways in the snow, I'm sure it was like that. Isn't that what they say? But I'm sure in a modern bank environment, it can sometimes feel like, hey, we have to gather some documents, we have to pay for verification, we have to check this box, and we have to move on to the next customer. I'm not certain that it's always regarded as we're protecting the customer and or protecting the bank. I shouldn't say that. I'm painting with very broad brushstrokes here, but I would imagine that in many cases, it's viewed as checking the box. I don't even know that there's a question in there. I'm setting you up for failure even by giving you a negative question. Please disagree with me, sir. Please tell me banks love to do this.
Well, I think for the first time in history, you're absolutely wrong. I would say that KYC should exist to protect customers, but too often in banks, it's viewed as a checkbox. And if that person is performing that KYC, they're checking that box because they were told that they had to, that the examiner had to. They don't understand like how they're protecting their customer, how they're protecting the bank. If there's an account that's a loss, the bank is going to be on the hook for that. So it has a financial impact to them. I think it's just it's an educational thing, and too often bankers are happy just to accept, oh, we just need this, like we need to check those boxes, so go make sure they're checked.
How does a bank know the difference if they're just checking the box or if they're aspiring to that ultimate identity utopia that we heard Eli mention at the end of his last statement?
I think it's the difference. It's largely going to be the difference between a brick and mortar smaller community bank versus when you add into this digital nationwide delivery mechanism. And you're really going to see the impact there as you grow. And so, like, can you get away with it at a small level? Yes. But the more velocity you have, the more likely you're going to, like, that risk is just going to grow and grow until you have that impact.
I think that's fair. I do think we should also call out the fact that there are quite a few consent orders that were KYC related. And I think that ultimately boiled down to perhaps some of these checking the boxes, some of these instances in which banks may not have understood their customers, or at least the way their partners were going about validating their
Well, I think
customers.
like if you look at the fun ones, like it wasn't even checking a box. They were using the middleware's address as the corporate address for their customer. Like, and they were using like there was one example where I don't remember how many thousands of customers had the exact same address, but it just like, oh, we just need that address, so let's check that box. Turns out they're international accounts that are very fraudulent, and then like we see the impact, a couple years later.
And also, just for example, TD Bank got one of these orders in 2024, so pretty recent, like October, and I believe the fines for both KYC and AML were over $3 billion. So I mean, it isn't just a slap on the wrist; it is truly pretty meaningful sense for the extent.
Yeah. $3 million, that doesn't sound like fun, Steve, but I definitely see your point as far as it is an interesting. Was that, Eli?
I'm sorry, 3 billion, not million.
Oh, 3 billion. Oh, that makes it more significant. I think I was having some challenges hearing you. Definitely a conversation, absolutely something to dig into. I want to move us along, gentlemen. We're a little over halfway, and we have several other questions I want to dig into with this group. So let me take us back over here to a topic of how we unify customer data. So let's get into that, gentlemen. And just this particular topic, let me add this back to the stage, our PowerPoint. Our slide deck. All right, here we go. So this concept, this is a busy slide, busy slide, but here's what I was trying to encapsulate here. In many cases, we see customers rekeying their personal information multiple times over to open an account. Definitely across different fintech providers that may be banked by the same sponsor bank. Now, that in and of itself is somewhat of an annoying customer experience, but an angle I hadn't thought much about until Eli came into our world is just the fact that banks also have to keep track of this very toxic data, these extra copies of PII information. And as you continue to add programs, it becomes really difficult, especially to separate out all of these instances if we don't have a good plan going forward. Eli, so far, am I on track with the concept that you were seeking to solve with Footprint? And it's fair if the answer is no. Oh, I hope, Eli, can you hear me? Steve, are you
I
able
can hear
to
you. Yeah, I can hear you. Eli, are you? Oh wait, I got it.
I can hear you.
Okay, very good. Well, why don't we go ahead and dig into
for some reason.
Ooh.
But I'm happy to chat about my favorite love life. I love.
How about I move on over then to?
Very true. I promise this isn't a discrimination thing. I can hear Steve loud and clear, and this is like this is heartbreaking for me. But we can use commentary.
Yeah, Stacey, if you want to put your questions in the comments, I'll be sure to.
How about I do this?
But I think.
How about we switch over
on the
here?
Side.
All right. Hey, so Eli, what is the difference between doing KYC and building an identity infrastructure?
Yeah, there are three core things here that I think are very important. One is that when you think about how does identity theft happen, they're top of funnel. And that may sound strange, but we talk a lot about thinking about fraudsters like smart operators. Think about fraudsters like a business because they are running a business. Whether it's the Lazarus Group in North Korea, which is state-sponsored fraud, or Kui1 in Cambodia, which is essentially a private company that has a massive HQ and does $1 billion of top-line revenue. And they're thinking about their P&L and their top of funnel, and they have two main sources. And one is breaches and the other is going to be phishing or those types of ATOs. So when you think about how do we prevent this from a top of funnel, you need to securely store data. If you're doing KYC, if you're onboarding people, if you've signed up to store their data somehow. So I think for the first one is that for too long, it's been viewed as a separate issue. And every time that you're moving data, you're setting yourself up for risk. And then also from a compliance perspective, whether it's with CCPA in California, Virginia's new privacy statutes, you're just going to want to have pretty good understanding of what's happening, especially BIPA in Illinois is going to be the biggest one. If you're collecting driver's licenses or anything dealing with the biometric and you're doing it improperly in Illinois, we've seen several companies get fined tens of millions of dollars for this. I think that when we think about what's next, there are two things that really stand out for us. One that's fairly unique that we do is when we think about duplicate fraud detection. Most KYC providers will delete data after 90 days, and it's up to the bank to find a place to store it for the 7-year legal requirement. What this means, though, is that if you offboard someone due to fraud and you have attached their name, your identity provider may not recognize this is a duplicate identity coming back. By being both an infrastructure provider who's doing the vaulting and then also doing the identity protocol, you're able to, in real time, see this, where you can flag a duplicate account coming back. So this is a way to mitigate risk. Then on the upside, if you're really thinking about your infrastructure, you're doing something else which is really key for banks, which is you went through a lot of time and money and protocol to find new customers and onboard them, and maybe they now have a checking account. And you probably next want them to maybe apply for a loan. By being the vault, you're much more simply able to both get people from products 1 to 2 and do this without having to collect a lot of net new information. So to me, this is where kind of the idea of infrastructure is really important, in that if you're viewing vaulting as a core part of your identity stack, you're both probably getting better at catching duplicate fraud, and then you're also going to do a better job at getting people onto multiple products. And I think this is why, when you think about, we started this conversation with KYC, but as we see, there's so many elements that lead up to how both banks and fintech should be thinking about more broadly, what does it mean to onboard and interact with our users?
Yeah, perfectly fair.
I think it's amazing to me. So you mentioned 90 days versus 7 years, and I'm not the best at math, but that seems like a very big difference between those two numbers. But it's, like you said, if KYC introduces friction and you want to onboard customers, so if you have that infrastructure layer, you can then reduce that friction as you add those other products. But it also, like, as Eli said, it was just, it spoke to me, like, so you're creating a better user experience for additional products, but also protecting the bank because that fraud is being there. Like, you have the infrastructure, it's staying for 7 years, not just a 90-day short-term window.
Yeah. And I know Eli may have challenges hearing me, but that kind of brings me to this next question. Because of that difference, I am curious to know how banks should be thinking about the storage of this information themselves, what they store versus what's vaulted with a provider. Eli, are you able to hear me now?
No. I'm going to take a stab at the question on the board. And context clues. I think this is a pretty interesting question. And it goes to two questions. One, Steve brought up at the beginning, which is who owns the customer, right? So I think that by storing, like, the more data you store, the more you do kind of quote unquote own that customer, which I think is important. And you're able to I think, kind of offer more types of services. With that said, I think you should be pretty smart. To me, the bigger question would be around, like, RBAC. What control should you have in place of who has access to what? We see some banks get much more fine-grained in terms of customer support, what they can access versus people internally. I think at the end of the day, it's going to come down to, like, data. My long-held belief as someone who considers himself a privacy advocate is that privacy does not mean less data. It just means safer data. I would argue there's a lot more upside. If a bank has more information about me, they're going to be better to offer me promotional offers, which I may want. So I think it's actually better for everybody involved. If there is more data, you just need to make sure you're properly storing it.
Yeah, love it. Well, Steve, I think you are going to be the Eli translator, since he can hear you, but not me, which is it's so funny, so interesting. I think we're going to move on to the concept of KYB, KYB and embedded. And just for Eli's benefit, I'll move over to this slide. Eli, we're going to go here to this topic to give you a little bit of an insight into where we're going. But why don't we go ahead and just tackle some of these questions, and then Steve, move a bit more into the panel discussion. So, gentlemen, for both of you, where does KYB break down when we start thinking about embedded? Because in my mind, we can see that it looks a little bit like this, where in the embedded space, Eli mentioned earlier, there's these very small, thin KYB files, especially when we're speaking internationally. I love how I'm speaking slowly and with my hands, if Eli will be able to understand and hear me through my words and versions. But there's these complex ownership structures as well. And there's all sorts of entities spinning up as companies get into new segments and new business models. And what I have found, at least from my experience and over the course of my career, working with bankers and working with fintechs that sell to bankers, so we often see bankers trying to make their processes fit. They try to make a local bank type of KYB program fit in this broader embedded space. So Steve, first of all, tell me, am I crazy there before we bring Eli into the conversation?
And I think I touched on this earlier, like with the former bank I was at, where they were running 3 to 6 months behind on their KYB. It was not uncommon. And so it does get very complex, and you try to use the same process for everyone when there's a lot of variability in it. Eli, are you able to hear her now?
I hear the intermediary, but I can definitely check. It's a very out of body experience. I have no idea how this can happen.
This is I can hear you both fine. It's weird.
It's so I gotta say though, one, this is an amazing graphic. So whoever is on the ambassador design engineering team, I think deserves a raise, and I'm guessing that's Stacy. 2, I feel very good that the highlighted box in the bottom right is then what we spoke about earlier of what does it mean to go from onboarding your own people to like a partner program. And part of this is exactly this. You go from commercial customers that and KYB business, I think, is one that people maybe overlook a bit when they think about, well, people commit fraud. But that's actually not true, because businesses often can get access to far bigger lines of credit. And also, there are far fewer databases of businesses. So the ability to actually create a compelling synthetic business or shelf, synthetic identities become a big term. Shelf business is kind of the equivalent for KYB. Mm-hmm. And this is very much on the rise. At the same time, I think embedded finance for businesses is one of the bigger opportunities out there, just because I think it is tailed behind. There are more and more small businesses there. And, if you think about it, lending is GDP, typically, historically, the small business open up what would you call a mom and pop store. I think KYB is really interesting. Have this full spectrum. There is and as he was saying, I understand how folks maybe overlooked it because they would go, I have fewer applications, so I don't need as many tools. I'd probably argue it's the opposite, where you want, just because the numbers aren't as much as KYC, you probably want to do more to verify business, because the business is going to have more opportunities and more options within your ecosystem. So that's what I'd kind of say. As you have on this slide too, ownership structures can get really complex. Complexity does not necessarily mean, pernicious or wrong, but it does mean that you're going to need to do probably more EDD. And this is a really good use case, once again, for agents, AI agents, which can go and actually research website presence, can find LinkedIn's beneficial owners, track them back, can go on Google Maps. And we've seen many banks get consent orders recently because they were onboarding through partners' businesses that all happen to share the same commercial address in Delaware, and it was just a building that wasn't actually a business. So I think kind of using tools now to make sure that you're actually doing business with a real business is more important than ever.
Yeah, I completely agree. Now, Steve, I know Eli, for some reason, still is having challenges hearing me, But I think we'll go ahead and move more into our panel discussion at this point. And why don't we, if you wouldn't mind to translate, Steve, let's talk to Eli about the AI agent realm, the AI teaser he gave us as we were leading into this call, and the conversations with regulators. And then we'll wrap up with how to find Eli and what we've got next.
So we've got about 10 minutes left. We're coming up on time, so I wanted to cognizant that. If there are questions, you can put that in the chat, and we will try to get to them. But Eli, would you let's go back to something you talked about a little earlier, the AI work that you're doing. Can you tell us about that and the value that it's bringing?
Yeah, I think there are two big areas that we see for AI for banks more broadly. I think one is what I'd say kind of this manual review. How can we cut 3 days, 3 weeks, 3 months to review people into 3 minutes? And a second is for financial crimes investigations. When you're thinking about filing SAR UAR reports, SARS filings, or when you're thinking about doing EDD reports. When we think about kind of like building a system of record for these investigations for banks, it's something that should get tied back on an entity level. So let me maybe paint a real world example of two of these. One is you're onboarding a business and it ends up in BDD. There are probably a couple things that you're going to want to do for that. One is you maybe want to investigate around, is this business on a sanctions list? Or are they transacting? If we pull their transactions, are they often transacting with people who are on lists? Are they a real storefront like we were just talking about? Can we find the owners of it online? Can we find the email and phone number on the website and call it and email and are they real? This is work that would take hours historically. And as a result of it taking hours, you would only do it from your highest 2% of businesses. AI really changes this where you can actually review more controls and automate it with agents that can, in 30 seconds, kind of work as a swarm to do these controls. Now, this unlocks a couple of things for banks. One is that it lets you do more of these reviews, which your examiners are going to like, and that you're probably going to like because, it's an arbitrary number of what percent is higher risk. All scores are weighted and configurable, and they're real, but they are weighted in a way that you can decide that maybe you want to weight something differently. So now the amount of businesses that are below an 80 on your threshold is 2% lower. Second is that you're going to feel more confident in the result because you're actually able to be doing these broader checks. And this may actually let you onboard more businesses because maybe it turns out those businesses that you thought were in the gray area aren't. Then on the other end, I think when you think about filing these reports or when you think about presenting evidence, there's this issue of you kind of as a bank as you scale, you either have to hire more analysts who are going to be spending their time or look overseas to VPO. And here you're going to just have to train for each new product. You're going to need to think about consistency. Actually, a question we discussed earlier, when you're a partner bank and you give 10 fintech programs a SIP and they interpret it, it's the same thing if you have an ED protocol and you give it to 5 different analysts to interpret. So you're able to deliver consistency here. Now, that said, there are trade-offs. So AI can hallucinate at times, absolutely. Like it is not going to be 100% accurate, 100%. I think what we see is that regulators are excited about the fact that we can guarantee at least consistency in protocol, as opposed to today when different people are going to have different interpretations.
Steve, why don't we go ahead and wrap up with one final question out here for Eli and yourself. And I'm going to put this one out here and then we'll wrap the call. You could change one thing, Eli, one thing about KYC, KYB, and how banks and fintechs talk to each other. What would it be? Steve, would you like to go first and then Eli can answer?
I don't know that it's anything new. It's the way they've always done it. It's worked for us the past decade or two. Why should we change that now? And that's in all throughout banking. We see that same mentality of we have a successful product, a successful bank. Why would we change it? And we live in an environment today where fraudsters are moving faster, the capabilities are increasing. I was just talking yesterday about Finovate. A couple of years ago, there were multiple companies that were like my voice is my password. And at the time, that was a very secure way of validating someone is who they say they are. But today with deepfakes, that's no longer a reliable channel to validate. And like, so banks cannot rely on legacy tech, legacy solutions to stay in front of the curve of this increasing like change and actually knowing your customer, knowing your business. So I think it's an openness to change and honesty of where they are, where their processes are, and how they operate in the world is what I would change when you're talking to banks and fintechs.
Over to you.
Would you?
I think that's fair. I mean, I think for the, if I could only change one thing, I think it would probably be around like, you know, we talk about like it goes back to checkboxing where I just wish conversations could be more around what are we actually trying to solve for instead of what do you want me to show. And that may sound like very similar overlapping questions, and oftentimes they are. But, you know, I think when it's a debate that I'll go back to scores. People like scores because they feel safe. And then you have a score and you're a fintech and your bank asks you, why do you approve this person? You go, they had an 85. And the bank goes, okay. We were actually speaking to a customer of ours the other day that said their bank loves scores because anything over an 80 they feel comfortable with. And then when an examiner comes in, and they say, why'd your fintech approve this? They said, well, it was over an 80. So I understand why this happens, and I don't really think this will change, but it does frustrate me on a problem-solving level of it kind of gets us away from the conversation of, well, what do we do in medium risk social security for a single? Because that would just be a much better conversation to productively solve these issues than how do we get more people above an 80.
Excellent point. Excellent point. I know Eli can't hear me, but good job.
She says good job, Eli.
I'm a terrible lip reader, so that was I appreciate it.
You did great. You did great. Well, I'm going to go ahead and wrap up our conversation. We have a few minutes left. For those of you that are joining us out here would like to learn more about how Ambassador may be able to help, listen, we are here for you regardless of where you are in your journey. There is no wrong way to do things. There is only just understanding where you are and understanding where you'd like to be, perhaps as a result of these conversations. So please let us know and reach out with our newsletters or follow what we're putting out there if we can be of assistance to you directly. You know, additionally, we know it's hard. It's hard to have these conversations in-house. If you are interested in banking as a service, but your board is not showing the same type of interest back, don't worry, we've got you. These are conversations that we have quite often. So that we can just assist in helping the board members understand the possibilities that exist as it pertains to embedded banking. And we also know other individuals in this space that have quite a compelling voice that can also offer some assistance here. But ultimately, coming up next, our next Layers and Players conversation is all around this concept of compliance testing, specifically in the banking as a service space. What's different, what you need to know, and we have some guests that are actually very exciting, even though this topic may not sound like it's the most exciting one. So stay tuned for the next invite coming up on the 19th of February, and connect with us out here, especially our special guest, Eli Walks, co-founder and CEO of Footprint. Gentlemen, any last words? We'll go ahead and let Eli maybe offer any last words, or Steve, perhaps I'll let you go and then you can let Eli.
I will let him. Eli, thank you so much for joining, and it's been a joy as always. For those out there, feel free to reach out. I found a new skill I can interpret to Eli. So if you have questions for him, you can actually reach out to me or him.
Please go through Steve. Yeah, please direct all, and he'll help get them to me in the proper format. Thank you so much, for having me. Thank you so much for the work you do here. Like these conversations, I think they're always fun with y'all, but they're also so important in that I think we all feel responsibility to be stewards to make sure this ecosystem thrives. And, I'm very grateful that y'all work with so many banks and fintechs to help them do it. So thanks so much for having me, and excited to continue the conversation because it never ends.
Thanks, Eli.
All right. Thanks,
Thank
everyone.
you all for joining us. We look forward to seeing you the next time.
All
Bye-bye
right.
now.
Thanks, everyone.